Determining taxable income and handling tax losses in a tax group, a comprehensive guide. Consolidation of financial accounts for tax group purposes. To accurately determine the taxable income of a tax group, the parent company bears the responsibility of consolidating the financial accounts of each subsidiary for the relevant tax period. This process is carried out through a method known as aggregation, wherein the parent company brings together all financial data of the tax group's constituent members. However, the consolidation does not end with a simple aggregation of figures. To ensure accurate representation of the group's overall tax position, certain intercompany transactions and adjustments must be eliminated. Elimination of intercompany transactions and adjustments. In particular, the parent company must eliminate all transactions that occur between members of the tax group. This includes any internal sales, services, transfers of assets, or similar financial interactions between subsidiaries or between a subsidiary and the parent company. Additionally, adjustments resulting from asset valuations or revaluations within the tax group must also be removed to prevent distortion of the consolidated financial results. By eliminating such transactions, the parent company ensures that only external, third-party transactions are accounted for in the consolidated taxable income calculation. Treatment of pre-grouping tax losses for a joining subsidiary. When a subsidiary joins an existing tax group, any unutilized tax losses it carried forward prior to joining are classified as pre-grouping tax losses. These losses are effectively absorbed by the tax group and become available for use as carried forward losses by the entire group. However, the utilization of these pre-grouping tax losses is subject to certain restrictions and conditions. 1. Attributable use within the tax group. Pre-grouping tax losses can only be used to offset the taxable income of the tax group to the extent that the income is attributable to the subsidiary that originally brought the losses into the group. This ensures that any pre-existing tax benefits of the joining subsidiary remain proportionally tied to that subsidiary's contribution to the tax group's overall income. 2. 75% cap on tax loss relief. The utilization of carried forward pre-grouping tax losses is subject to a 75% tax loss relief limit. This limit is applied at the tax group level, meaning that the group's taxable income can only be reduced by a maximum of 75% of its value in a given tax period through the use of carried forward losses. Joining and leaving tax group rules. When a new subsidiary joins the tax group, the unutilized tax losses that exist within the tax group prior to the inclusion of a new subsidiary cannot be used to offset the taxable income generated by the new subsidiary. This ensures that the tax benefits associated with pre-existing tax losses are limited to the original members of the group. When a subsidiary leaves the tax group. If a subsidiary departs from a tax group, it retains any unutilized pre-grouping tax losses that it originally brought into the group. However, any tax losses that were incurred while the subsidiary was a member of the tax group remain with the group and do not transfer to the departing subsidiary. Example 34, Formation of a tax group in practice. To illustrate the application of these principles, consider the following scenario. Scenario Overview. C LLC, a UAE resident company, acquires F LLC, another UAE resident company, on 31st March 2026. F LLC wholly owns Z LLC, also a UAE resident company. As a result, C LLC owns 100% of the share capital and voting rights of F LLC, while F LLC owns 100% of the share capital and voting rights of Z LLC. Though C LLC does not directly own shares in Z LLC, its indirect ownership through F LLC satisfies the ownership requirements for forming a tax group. Consequently, C LLC, F LLC, and Z LLC apply to form a tax group effective from the tax period beginning 1st September 2026, an application which is approved by the FTA. Consolidation of accounting income. At the end of the tax group's first tax period on 31st August 2027, the accounting income for each group company is as follows. C LLC, AED 10 million. F LLC, AED 8 million. Z LLC, AED 9 million. The consolidated accounting income, therefore, is AED 27 million. Additional details include: F LLC and Z LLC received domestic dividends totaling AED 3 million, which are exempt from corporate tax. C LLC incurred AED 250,000 in client entertainment expenses, of which only 50% is tax deductible. Determination of taxable income. To determine the tax group's taxable income, the parent company must first exclude the AED 3 million of exempt dividend income from the consolidated accounting income. Next, it must make an adjustment for the non-deductible portion of entertainment expenditure, AED 125,000, resulting in the following calculation. Consolidated accounting income, AED 27 million. Less exempt income, domestic dividends AED 3 million. Add non-deductible entertainment expenditure, AED 125,000. Taxable income, AED 24,125,000. Utilization of carried forward tax losses. C LLC has AED 5,500,000 of tax losses carried forward from a previous tax period. As per the 75% cap on tax loss relief, the maximum amount of taxable income that can be offset is AED 18,093,750, 75% of AED 24,125,000. Since the carried forward losses are less than this limit, C LLC can utilize the full AED 5,500,000 to reduce the tax group's taxable income. Taxable income of the tax group, AED 24,125,000. Less carried forward tax losses, AED 5,500,000. Final taxable income, AED 18,625,000. Tax calculation. The tax group's corporate tax liability is calculated as follows. 0% on the first AED 375,000, AED 0. 9% on the remaining AED 18,250,000, AED 1,642,500. Corporate tax payable, AED 1,642,500. Impact of a change in ownership. On 4th November 2027, C LLC sells 50% of its shares in F LLC. As a result, C LLC no longer meets the ownership requirements for F LLC and Z LLC, leading to the dissolution of the tax group effective from the beginning of the next tax year, 1st September 2027. This comprehensive example demonstrates the intricacies of forming, managing, and dissolving a tax group, along with the careful application of tax consolidation, loss utilization, and compliance requirements. For more details, contact us.